I think what we saw was that because of the lack of visibility, the number of companies that had actually suspended guidance, the market was being forced to look at the medium or the long term. And now that we are actually getting some earnings guidance, we're getting reports coming out, and companies are missing what were frankly very low baselines, and they're beating them. We're seeing some relief from the markets, not just because of the supposed beats, but also because they're starting to get some visibility on what earnings are going to look like going forward. So it's a combination of beating some very low baseline measures, but also having visibility, which we didn't have up until now.
You guys are fairly bullish on global large cap equities. Give us your 2 cents on what's going to be the driver from here for further gains in some of these stocks, which have already rallied pretty significantly from the March lows.
Well, we believe that rates are going to stay lower for longer. We also believe the yield curve is going to remain flat for a very long time. And so if you put those together, that does mean that we look for growth to outperform value. And where you see growth is in large cap tech, in healthcare, for example. And, given that those have also been beneficiaries of what have been the changes in behavior after the COVID pandemic, we think those stocks, even though they're highly valued, remain well placed in the medium to long term going forward.
How do you reconcile that view with this view that seems to be gaining momentum in markets, that Europe is at a turning point and this European Recovery Fund approval is going to change the trajectory, the structural nature of the European Union, and really provide support for European markets from here? Europe, obviously, a much more value cyclical market than the U.S. Why don't you like those stocks given the new support we've got?
I mean, we think this support is definitely a positive. However, there are still headwinds for Europe, and Brexit, which was always going to be a lose-lose, is something that the market has been distracted from recently. That's going to rear its ugly head by the end of the year. So you're right in saying that the recovery fund is definitely a positive for Europe, but the high weight of financials in Europe, which we think is going to remain very challenged by the rates environment, the high weight of energy in Europe, which again is going to remain challenged by the low oil prices, is going to continue to weigh, notwithstanding the political risk that is going to come from Brexit as well. So we've definitely become more positive on Europe, and the recovery fund is definitely a good thing. But at the same time, there are too many headwinds for us to kind of favor Europe versus the US right now, for example.